tariffs on, tariffs off. Does anybody actually know what's going on? And do the markets have anything that they've decided about what they're going to do about all of this? That's what we're going to explore here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is, first and foremost, attempt to anchor ourselves in the price action and see what it was that markets did, and then try to see if that tells us anything about what they will do next, especially as all of this sets us up for another round of notable economic data. Some of it coming at us tomorrow, some of it coming over the weekend, some of it coming early Monday next week, and giving us all kinds of things to chew on when we try to unpick what in the world all of this is actually going to mean for traders. So let's first and foremost take a look at what the news was and what actually occurred. So this is a handy chart from The Economist. It follows a dual announcement from U.S. federal courts that put the Trump administration's tariff plans in limbo. So to make this as painless and as minimally confusing as possible to those of us that are not legal scholars and deep wonks on trade policy, the Trump administration cited what's called the International Emergency Economic Powers Act, or IEPA, to basically say that the fentanyl crisis, as well as persistent trade deficits, constitute a national emergency, which give the president the authority to regulate imports. And on this basis is how they introduced sweeping reciprocal tariffs and said the floor on tariffs is 10% for everybody, all trading partners, all goods. All of these kind of big, broad strokes moves were based on this idea, this 1977 act. And two separate federal courts said, no, you can't do that. The U.S. Court of International Trade, as well as the D.C. District Court, both of them basically said you can't read the law that way and put a hold on these tariffs. And so what you see in this graphic here is those tariffs that have been struck down by court order. And you can see it's all of these IEPA tariffs. So this one on Canada, the 10% reciprocal, this one on Mexico, this one on China and Hong Kong. And these are largely the fentanyl ones. This is the reciprocal one that is now on hold. Obviously, we've had the president announce that both the China part of the reciprocal tariffs and everything else are on a 90-day hiatus. The excluding China hiatus expires in early July. The China one expires in early August until these decisions. Now it's unclear. And so you still have quite a bit of the tariff infrastructure in place, but it's on these other bases. And what now follows is, well, of course, the Trump administration has appealed the court's decision and is going to fight it, and that'll probably go to the Supreme Court. But also there is another set of avenues that could get used here. So the 1974 Trade Act, as well as the Trade Expansion Act of 1962, have sections in them like the sections you see here. So, for example, Section 232, Section 301, that come from these acts that would allow the president to justify some tariffs to some extent. However, it would be markedly more difficult to do than the sweeping IEPA tariffs, because, for example, under the 1974 Trade Act, what the president could do is 15% or up to 15% tariffs for 5 months. And maybe that gives him enough time to figure out what's going on in the courts. Maybe it doesn't. We'll see. But you could do that. You could do some of these other things, but all of them require significantly more legwork. All of them require significantly more justification. So, for example, Section 201 of the U.S. Trade Act of 1974 is a safeguard provision. So the president would have to argue that a particular industry is unduly hurt by imports and could have a tariff there. Those would not be sweeping tariffs even against the country. They would be specific sectors, specific goods. Section 232 of the Trade Expansion Act would allow the president to act on the basis of national security. It would be difficult to justify that, for example, for the tariffs the president has performed on Hollywood or rivals to Hollywood. It would be difficult, obviously, for all things that you couldn't easily explain as a national security concern. Section 301 empowers the president to take action against untoward or burdensome or discriminatory or unjustifiable trade practices by trade partners. But again, you'd have to prove that. There would have to be investigations. So all of this could take quite a long time to do. And really the best hope for the administration now would be that they could get the IEEPA decision overturned on appeal. But if all of that is making your eyes glaze over, and if all of that is difficult to parse, well, the markets agree with you. Because the price response that you get to all of this is first exuberance and then dispirited capitulation, really. Because what you find for stocks, and we'll use the S&P here as a kind of benchmark for the markets as a whole, but what you find is we rally to 2-month highs here on the S&P. We hold there for a good 4 hours, and then all through the U.S. cash equity open and all through European trade, as a matter of fact, we retrace back down and end up with this capitulation where we essentially finish the day unchanged. And this extrapolates across markets. So bonds initially have a significant move down as the news gives you a boost to yields, ostensibly because putting the tariffs off to the side would be better for growth. But you don't get that sticking. The bonds end up finishing the day higher. Gold ends up with a significant decline initially, then rebounds and closes up with meaningful gains. The US dollar, and we're looking at it here against the euro as a kind of benchmark, it attempts a rally in the wake of this, probably helped on by higher yields, as we just saw in the bond market, and then finishes the day with meaningful losses. This sort of seesaw price action tells us that the markets would welcome the tariffs getting shelved, obviously, but they don't see it that way. They likewise don't see it as the tariffs being able to go forward. What they see, it would seem, is uncertainty. And whereas they were starting, perhaps, to get acclimated here to the idea that the president is amenable to market discipline. He's not looking to forcibly extract the U.S. from the global financial system, of which the dollar and the treasury bond are bedrock instruments. It is not the goal of the administration to do tariffs for tariff's sake. Friendly conversations and speedy negotiations get things reduced or paused or otherwise canceled, at least for some amount of time. The markets were just coming around to getting to grips with that idea. And what we have now is, rather than having cliffhangers on tariff policy when the reciprocal tariff pauses expire in early July and mid-August, we might have a 5-month window here where we don't know what's going to happen, because that's how long it would take to use the Trade Act of 1974 to try to create a window of opportunity to then re-justify the tariffs on a different basis. Difficult as it would be, because you'd have to go country by country, and in some cases, goods sector by goods sector, which would take very long and be very difficult. And if you kind of fudged it, then the courts would just block you again. So all of this seems to ultimately end up with the markets having decided that this means more uncertainty. And if we've learned anything about these tariffs, it is that the markets hate uncertainty more than they do the tariffs themselves. We saw that the tariffs did not materialize in November, when a presidential candidate by the name of Donald Trump had spent years talking about tariffs would be a linchpin of his administration, and then he won. Markets had the opportunity to sell off there, knowing the tariffs were coming in some fashion, but they didn't. They waited until here. And this is when worries about tariff implementation began to show up in declining business and consumer confidence and began to drive a growth scare. Well, we're back to uncertainty mode, because once again, we don't know what's going to happen and when. And the markets speak to that idea. This, of course, mirrors what we've just heard in minutes from the last Federal Reserve meeting. They don't know what's going to happen either. You can see here in the comments, clearly uncertainty about the outlook has increased. The risk of higher inflation and higher unemployment has risen. That may amount to difficult trade-offs for policy, because obviously those things would pull policy in different directions. But the bottom line is growth projections have been lowered. And inflation, almost all participants agreed, could prove more persistent than expected. In other words, the Fed, funny enough, believes itself to be well positioned to wait for more clarity. That is, they don't know what they're going to do, and they're not going to say anything specific. In fact, as much came out, it would seem, when Chair Powell met with President Trump for the first time since 2019 today. The markets seem no wiser. If we look at the range of expectations for second quarter GDP, never mind the actual GDP now forecast, that's still evolving here with incoming economic data, and the next update is due tomorrow. But the range of expectations from market economists here is extraordinarily wide, from negative 1% annualized to 3% annualized. So nobody seems to know what's going on, and most importantly, nobody seems to know where the economy is going. We did get a revised set of GDP numbers today that gave us a slightly smaller decline, 0.24% versus 0.3% initially reported. The upshot still basically the same. A surge in imports and a surge in inventories as companies front-run the tariffs, but still the weakest consumption in almost 2 years. The reference point there going back to the second quarter of 2023. And of course, that's the scary part of the story, because consumption is 68.5% of GDP, and everything else is not even remotely on the radar. In fact, when you net out exports and imports, which is how they go into GDP, net exports, exports minus imports, the impact is something on the order of 4.5% of GDP, as compared to obviously a much, much larger share for consumption. And this is where things get interesting. Because if the Fed doesn't know what's going on, if the markets don't know what's going on, And if the tariff conversation has been pushed out for who knows how long, the real question is how much more uncertainty can the economy bear, and what will be the economic impact of that uncertainty? Because what we've seen clearly is businesses are front running the tariffs, trying to build up as big of an inventory as they can before some of the higher tariff rates bite, but consumers have been led away from spending. They clearly are uncertain here and have become defensive. And that's much more significant. With that in mind, we look to PMI data coming out over the weekend from China and on Monday from the US, perhaps most critically showing that manufacturing in both economies is in contraction mode. Of course, PMIs, as ever, operate around a center line of 50, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So here, Chinese manufacturing expected to contract at a faster rate. U.S. manufacturing expected to contract at the same rate as in April. New orders seen contracting at a faster rate. A bit of a pop expected in prices. Not surprising, of course. In fact, we saw in the PPI data last week that the prices for companies are surging. They're just eating it and not passing it on to consumers and taking lower margins. China's overall economy, with a tepid rise in services, is expected to basically end up at standstill. We'll see what the ISM version of what the U.S. economy is doing is going to look like once the service sector numbers come out later next week. But in all, these numbers have pointed to standstill for the U.S. economy. And that, of course, is a problem for the whole global economy, because the U.S., the Eurozone, and China make up 58% of global growth, and most of the remaining 42% are vendors to those three and depend on those three to generate demand. So 58% is, as large as it is kind of an understatement. Now, if we then get into a place where the markets are unsure and the Fed is unsure, and the Fed is going to let whatever economic downturn happen before it really knows that it's ready to cut rates. Again, apparently that's what Chair Powell told the president today. It's what these minutes suggest. It's what the latest policy announcement suggested. If that's where this is going, well, then we have ourselves a global recession threat on the menu. As a matter of fact, global growth is already at its weakest in just about 17 months. We're looking here at global PMI numbers, and we can see that they've been showing deceleration since early last year and have very much accelerated in that direction since the beginning of this year. Going down the big inputs here, the Eurozone, based on its latest PMI numbers, back in contraction mode. So no help there. China, we can see, is already looking anemic come April, and the numbers that we are expecting here, obviously, are not going to be much better. Here we have a composite of 50.2. We're expecting nominally better at 50.4, but still essentially the same story of anemic standstill. For the U.S., the S&P Global version of the PMIs gave us a little bit of a pop, but it was again all about tariff front running. We can see that here. Almost all of the contribution that really stands out here is from restocking, whereas employment is still in contraction mode and everything else is kind of still downbeat. Meanwhile, inflation continues to surge. All the input and output prices across both manufacturing and services showing that the tariffs are in fact exacting a cost. It's just companies are eating it and consumers haven't seen it yet, at least in the US. But they expect to see it because we're going to get revised inflation expectation numbers out of the Consumer Confidence Survey due tomorrow from the University of Michigan, and it is expected to show some of the weakest confidence, or confirm early estimates showing some of the weakest confidence since the trough post-COVID, and blisteringly high one-year inflation expectations, higher, in fact, by almost 2% than the COVID peak. Now, we did see a little bit of an improvement in consumer confidence on the conference board's version of this data, but how much does that help? It's still quite low, and this was largely around the trade deal, or at least the trade hostilities pause with China. But now the tariff situation has been thrown into limbo again, and who's to say what any of it means once again? So the bottom line seems to be businesses have accumulated vast inventories, which if consumers don't buy, then this is a non-performing investment, and that will diminish further buying downwind, because if these inventories aren't cleared, then there's really no impetus to keep buying at even a regular sort of pace going into the second half of the year. Consumers look defensive, and the markets look exhausted and feel like the sentiment improvement that we saw here is maybe out of steam now, because it was largely around the White House becoming somewhat more digestible in its tariff policy and the markets becoming somewhat more acclimated to what's going on, but the stage has once again shifted. And the upshot here may well be that we're just going to position for a long slog on policy and a slide toward recession, waiting for the Fed to act if these PMI numbers are going to show up as expected. And that probably means weakness for cyclical assets like stocks. It probably means speculation on rate cuts later downwind showing up in the long end of the curve. So it probably means higher bonds, and by the same token, higher gold, and by the same token, a weaker dollar. We'll, of course, see if all of this holds with the benefit of 24 hours because the tariff story continues to be in motion. But Macro Money will be back next week, as we are every week after overtime, Monday through Thursday. I'm also on for Futures Power Hour with Chris Vecchio on Mondays and Fridays, on with Victor Jones for the Price of Truth on Tuesdays, writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money's back next week. Take care.